I think we'll get started. So thank you for signing in for our webcast Market Outlook with Ed Yardeni. It's our pleasure to host Ed. This is our second call. The first call that we did was extremely popular, and we thought, given the market turbulence, that this would be very timely. So today I'm gonna be asking questions of Ed. The call will go less than an hour. The structure of the call will be as follows. I'm just going to give a brief review of our firm and our funds and how we're doing. And then in our Q&A, we're going to divide it into 4 categories. We're going to talk to Ed about his market outlook, asset allocation, and sector preferences. We're going to talk about monetary policy. We're going to talk about fiscal policy, and then we're going to talk about geopolitics, and in particular, Europe. So with that, I think we'll get started. So in all of the things that we're going to talk about today in terms of our funds and our firm, there's a disclaimer on our website, hamiltonetfs.com/legal, for all of the relevant disclaimers. In terms of the firm and how things are going, we are, without question, the fastest growing ETF manager in Canada. Our AUM has more than doubled in the last 12 months. Our AUM now is over 1.6 billion across 10 mandates. We are now the #2 provider Canadian bank ETFs with HCAL and HCA. In terms of highlights, we have 5 financials ETFs designed by a team of sector specialists. We have 5 enhanced ETFs, which we've designed for higher monthly income and growth. In particular, we draw your attention to the Hamilton Enhanced Canadian Bank ETF, which currently has a yield of about 7.4%. It is the top performing Canadian bank ETF. Its AUM is headed towards 400 million. And we recently launched the Hamilton Enhanced Utilities ETF, ticker HUTS, which is a combination of Canadian utilities, pipelines, and telecom. It has a yield of about 6.7%. I wanted to mention, so we have been a long time subscriber of Ed's services and client of Yardeni Research. Ed, as everybody already knows or likely knows, is a very prominent Wall Street strategist. He's on CNBC regularly. He's held positions at the Federal Reserve Board of Governors and U.S. Treasury Department. He previously served as the chief investment strategist of Oak Associates Prudential Equity and Deutsche Bank's U.S. Equities Division. He also has a very good book called Fed Watching for Fun and Profit, which is available on Amazon. And I do want to point out that you can sign up for a 4-week complimentary trial of Yardeni Research by going to yardeni.com and just click trial. And Ed, you were mentioning that you have another product as well?
Yeah, we recently put together something that might be more useful to people who want a kind of a quick analysis of things. It's called Yardeni, Y-A-R-D-E-N-I, Quick Takes, one word, YardeniQuickTakes.com. So have a look at that. Okay.
That's very helpful. Thank you. Just going to give you a couple quick investment ideas, given all the market turbulence, and then we'll get started with the Q&A. So the first idea would be HCAL, the Hamilton Enhanced Canadian Bank ETF. It's, as I mentioned, the top performing Canadian bank ETF, outperforming equal weight and cover calls by wide margins. Distributions paid monthly, 7.4% dividend yield. It has a high return and similar volatility to an average Big 6 Canadian bank. It's basically exposure to the Big 6 Canadian banks with just a modest amount of leverage. The idea here would be to buy HCAL and to sell any individual Canadian bank position and or Canadian bank ETF. You can see the yield is quite a bit higher. And the volatility profile, again, is not meaningfully different than an individual Canadian bank. The other idea would be the Hamilton Enhanced Canadian Financials ETF, which is a sister ETF to HCAL, offering, instead of not just the Canadian banks, but it's the Canadian banks plus the insurance companies plus Brookfield. It has a 7.2% yield paid monthly, so you get a bit more diversification by owning, having an allocation of banks and insurers, and Brookfield. It has a 7.2% yield. Again, the Canadian financials are around 4.2, and the if you look at the Selective index that this is based off of, and you compare it to the Canadian financials, it's had significant outperformance. And then on HUTS, our new fund, Hamilton Enhanced Utilities ETF, This is actually quite interesting. Equal weight portfolio of 12 Canadian utility, pipeline, and telecom companies, again, with just a modest amount of margin, about a 6.7% yield. Again, this is if you own an individual, if you own BCE, if you own TELUS or Rogers, this would be an appropriate substitute. You get a higher yield and a higher potential return. So the yield here is 6.7. The Canadian Utilities Index is 4.2. And again, this is paid monthly. And then we have two broad-based retail products. The first one is HDIV, equal weight portfolio of sector covered call ETFs. Right now, it has a yield of about 11% paid monthly. It's outperforming the TSX 60. It's basically a synthetically created income version of the Canadian equity markets. Buying the idea here would be to buy HDIV, sell any Canadian equity ETF, broad-based, or any sector covered call ETF. The yield here is dramatically higher. This has actually been a very good product. It's over a year old, so we can talk about its performance, and it has outperformed the TSX 60. And then lastly, a sister ETF to HDIV is HYield and HYield.U, much like HDIV, which is sort of a synthetically created version of sector covered call ETFs, mimicking broadly similar to the TSX 60. This one here is broadly similar to the S&P 500. It actually yields a fairly high 15% paid monthly. There's two versions, HYield, which is CAD hedged, HYield.U, US dollar unhedged. Now HYield is in Canadian dollars, so its return reflects a depreciating Canadian dollar. Buy HYield or HYield.U and sell any US equity or sector covered call ETF. The yield here is quite significant. So with that, I thought I would get started. So I thought we'd start off, Ed, with your market outlook. So if I could just very briefly, the general backdrop is more or less as follows. Higher inflation, including high energy costs. Central banks are rapidly raising rates. You have this unknown or unquantifiable quantitative tightening, or QT 2.0, expansionary fiscal policy, a very strong US dollar, and excluding today, falling equity markets. Today, we had fairly big news. Core CPI hit a 4-decade high, but the market looked through that, and the market is doing quite well. Can you talk about your market outlook, and in particular, your thesis of rolling recessions that could result in a growth recession?
Yeah, I think that we have been in a recession since the beginning of the year, but it's not a hard landing kind of recession. It's more of a rolling recession that's been hitting different industries at different times. Clearly, housing has been hit hard. I think we're starting to see some effects of higher interest rates on the auto industry. On the other hand, multifamily housing is doing quite well, and while consumers have cut back on durable goods spending, which has created a recession in the retailing sector where they have to discount inventories to lighten up on the overhang, they are moving towards services. In capital spending, we're probably going to see some weakness, and we've seen some weakness obviously in semiconductors related to PCs, but on the other hand, cloud computing, the whole cloud universe remains a very strong area of spending. And I think the shortage of labor is something that companies can only really seriously address by increasing their productivity, by buying technologies and capital goods that have the impact of increasing productivity. So I don't think we're going to have a outright decline in the economy that's going to, on those charts show up with the gray shades showing that the economy peaked here and troughed there. I think this just continues to mosey along at a very low rate of growth. We had slightly negative growth in the first half of the year. As I've been talking about this growth recession, we get this Atlanta Fed model. Anybody can find it on the internet. The Atlanta Fed, whenever an economic indicator comes out, puts it into their tracking model, and they're estimating that GDP is actually growing 2.7% during the third quarter. So that's a bit of an outlier, but I think we're looking at something like 0 to 1.5% growth over the next few quarters. We still have plenty of downside in our housing market, for example. At the same time, I guess I'm coming around, especially after today's CPI news, to conclude that maybe we also have kind of rolling inflation. rolling through the economy, hitting different sectors and segments at different times and moderating differently. So, for example, we know that the demand shock that occurred in 2021, the demand shock was fiscal and monetary policies were extraordinarily stimulative. They've been stimulative since the pandemic, but by 2021, it's not clear that we needed to continue to get all of this stimulus. But we certainly got a third round of checks deposited into people's accounts. It's basically helicopter money. The fiscal authorities have been dropping money into people's deposit accounts. And look, we were all locked down, at least in the United States. Our lockdown lasted just 2 months. It was March and April, and that resulted in a really, really bad recession, but it only lasted 2 months. And maybe it kept us from getting COVID that otherwise we would have gotten if we hadn't kind of stayed home. But we all got cabin fever. And so when we had some savings built up for a couple of months, plus those checks, plus remarkably easy monetary conditions, there was a tremendous demand shock that overwhelmed the goods sector. The supply chain really got shocked. And so we had a tremendous surge in durable goods inflation in 2021 going into early this year, but it's peaked, and now we're seeing that those price inflation numbers are coming down quite substantially. We even had used car prices up by 50%, which was just crazy on a year-over-year basis, and now they're down to zero, and I'm not going to be surprised if we see some declines there. Same thing with new car prices, went up 10, 15%. Maybe those things stop going up and they may actually come down. Anything housing related, because of the housing recession, so housing related retail sales have really been quite weak, and so those prices are coming down. We have seen that as a result of the Ukraine war early this year, we had a surge in non-durable goods inflation, which was to a large extent energy and food inflation. And while we haven't really seen any meaningful, food inflation is still going up, but we have seen that energy inflation moderating. And I think a lot of that had to do with the fact that the oil shock combined with the central bankers turning to tighter monetary policy, all that has slowed economic demand. I think China's in a recession. I think Europe's in a recession, or if they're not in it, they're heading to recessions that are going to be depressing demand for commodities. Commodity prices look like they peaked in the summer, broadly speaking, and the same can be said for energy. Now, OPEC recently said that they're going to increase their price, that they're going to reduce supply by 2 million barrels per day. But I would point out that they are probably just acknowledging that demand has come down by 2 million barrels per day. In the United States, when we had gasoline over $5 at the beginning of July, as we were about to go on our holiday vacations, it turned out that Americans very quickly cut back their consumption by 1 million barrels per day of just gasoline alone, when you compare it to where it was the same week a year ago. And that's continued right through the latest week. So I think we're going to start to see some improvement in the non-durable goods inflation rate. Food, I'm not so sure about, because there's a pretty bad, terrible drought in California that's having an impact on food prices. But again, looking at commodity prices of livestock and grains and agriculture generally, it looks as though they peaked in the summer. Obviously, commodity prices don't go straight down. Sometimes they can come up a little bit. But I think the agreement between Ukraine and Russia to allow both of them to sell grains has taken a lot of pressure off the global grain markets. So that brings us to services. And right now, inflation is rolling through the service economy, particularly into rents. And everybody knows that the rent measures are highly flawed. They're measuring rents of all rents that are of leases outstanding. So it's only on the margin that you start to see the new leases being reflected in the rent. So we know from Zillow that rent inflation has soared from something like 5% about a year ago to 17% earlier this year, and now it's coming down pretty rapidly to 12%. So kind of the real-time data is showing that, yeah, we've had a real surge in inflation in rents. Now, don't forget, a lot of landlords were not allowed to raise their rents during the pandemic, And it's only been over the past year that they've been allowed to do so. So they're doing some catching up to do. I think in many ways what we're seeing here is we're going back to the old normal. Remember, people used to say this is the new normal. Well, the new normal was one where interest rates were near zero and where inflation remained under 2%. The central banks couldn't get it going, and growth was relatively slow. We may be going back to the old normal where inflation is more like 3%. I don't think we're going to get it back down to 2%. I think the Fed's going to have to concede that at some point. Right now, they're still talking about getting it down to 2%. I think bond yields may very well stabilize around 3.5% to 4.5%, and that's not necessarily a bad thing if the economy, in fact, can continue to grow and inflation stays down. But obviously, it's not going to be something like 2%.
Yeah. So basically, I guess the idea, just to wrap it up, or sorry, to summarize, is that different parts of the economy are seeing slowdowns at different periods of time, and because of that, you're not getting the significant downdraft in GDP growth. Instead, you're just getting slower GDP growth.
Correct. And,
okay.
And the same thing applies to inflation. It's kind of rolling through the system, and you're making progress in some areas and having some setbacks in other areas. And I mean, if I always get reporters calling me on a day like today and said, what's the market now? And so if I had to come up with an explanation, it would be that perhaps the market just seeing through the problems in services, and particularly in rents, and that those measures are flawed, and that this is not exactly the end of the world. I mean, it certainly felt like at first, it felt like Armageddon at the beginning of the day.
Yes, it did.
When the numbers first came out, and then it just completely turned around, which indicates to me that there's a lot of money on the sidelines. A lot of people have already sold. I mean, the panic has already occurred, I think. I mean, everybody keeps waiting for some capitulation, but I think there's been a lot of capitulation in the first half of the year. So I think the market's going to go sideways for a while with a lot of volatility. I thought the June 16th low of 3,666, that devilish number, might have made the low, and instead, much to my chagrin, it kept going lower. But now we're back above that number. But in my scenario, earnings kind of go flat. They don't take a dive the way they take in a recession. And valuation multiples, well, we're down to 15. If you take out the mega cap 8, the big tech names, you're at 13 and a half. And people still like those big cap tech names. You can see in a day like today, they're running back into the Microsofts of the world.
Yeah, so that actually is a good segue to, I think it was earlier, about a week ago, you wrote that this is the most widely anticipated recession in history.
Yeah.
Presumably, you meant there was a lot of bad news already priced into the market.
Yes.
So I was going to ask, so PE multiples for the S&P 500 have fallen, 4 to 5 multiple points.
Yep.
There hasn't really been any material decline in forward EPS estimates. So it would seem like, would you agree that the market seems to be pricing in what is, a not modest recession, but a more deeper recession? And
yeah,
soft landing, there would be an opportunity for the markets to rebound.
Yeah, well, I wrote that piece just the other day about this being the most widely anticipated recession of all times, after Jamie Dimon, CEO of JP Morgan Chase, declared that he didn't put any probabilities on it. He just said we're going to have a recession in 6 to 9 months, and the market's going to go down 20%. You should probably listen to him, because he's smarter. He's runs a big bank. He's probably got a lot more micro data than I do, and he's a lot richer than I am. So go with the rich guy. But I've been saying this for a while, that everybody's been talking about a recession's coming since the beginning of the year. And then when we had 2 negative quarters, slightly negative quarters in the first half of the year, everybody declared victory and said, see, it's a technical recession. But it's really more like a growth recession. It's more like a rolling recession. It's more like what I sometimes have been called a mid-cycle slowdown. We had one in mid-1980s. We had another one in the mid-1990s. And we had another one in 2014, 15, 16. They do happen. And they do stir up a lot of concerns. Now, look, if I'm just dead wrong here and we have a hard landing, then Diamond is right. There'll be another 20% drop. And in hard landing recessions, everything goes wrong. Your revenues go down, profit margins go down, so earnings go down, knocked down by both variables. And then valuation multiples, which kind of got down to like today, 15, 16, suddenly it's like, wait, those are way too high. And you get down to 6, 7, 8. I mean, they're miserable bear markets. Not that this one's been a walk in the park. It's been pretty miserable as well. But again, in my scenario, the dire forecasts don't pan out.
Yeah. So one of the important variables that's kind of lurking in the background here is a very strong U.S. dollar. So can you comment on how this strong U.S. dollar is influencing your market outlook? And I assume you would believe that it has implications on emerging markets as well.
Yeah, absolutely. Yeah, I've been promoting the idea of there's 3 investment styles, major investment styles. There's a whole bunch of them, but in terms of major investment styles, there's big cap versus small cap. There's growth versus value, and there's what I call stay home versus go global. Do you want to, stay home for an American is, do you want to overweight the U.S. or do you want to overweight the rest of the world? And I've been promoting the idea of staying home, overweighting the U.S. really almost since the beginning of the bull market, and it's worked out very well. And over the past few years, what's really worked quite well, obviously, has been the mega cap 8, and they are kind of unique kind of companies, and other countries don't have as big a technology sector, and those kind of global companies that are widely sought after and want to be owned in portfolios. And so I may be overstaying my welcome here, especially with a strong dollar. You would think that that would start to weigh on corporate profits here, but on the other hand, it would be pretty good for profits for other companies in other countries. But I'm looking at the global picture, and it looks it's a pretty tough environment for global investors. So you got that horrible war in Europe. Europe looks like it's going to be falling into a recession that they didn't anticipate. That the transition from fossil to clean energy would take a long time, and they kind of rushed it, and became too dependent on Russian oil and gas, and now that's being shut off. I think China is falling into a recession. I think they got a property bubble that's bursting, and it's bigger than anything we had in 2008, 2009. The difference is the Chinese aren't going to let their Lehmans fail. They're going to prop them up. But nevertheless, it is going to depress the property market. It's one of the reasons the copper prices are down, as we got a global housing market. I think you folks in Canada certainly are seeing some aspects of that. So I've come up with this idea of TNIC. Remember TINA during the bull market up until this bear market, people said, TINA, there is no alternative to stocks because bond yields were so low. Now we know that there are alternatives to stocks, namely bonds yielding 3%, 4%, 5%, and of course some of the funds that you're running have some pretty juicy returns. So there are alternatives to just outright stocks. There are bonds, and there are ETFs and funds like what you guys run. But I would say that all in all, when you look at investing on a global perspective, I think there is no alternative country. That's the TNIC.
Right.
For global investors looking for safe havens, the U.S. is it. And honestly, it's not so much a forecast as just like, well, just take a look at the dollar. The fact that the dollar just keeps going up, up, and up. I mean, I think it was up a lot this morning, and then it gave back some. Everything's been kind of wacky today. But the strong dollar indicates that, look, they're not buying dollar bills to put under mattresses. Foreigners are buying dollars to buy bonds. We know there is monthly data on bond purchases, and they've been buying bonds big time. They haven't been buying stocks, but I think that's what's going to happen next. So I think on a relative basis, I would continue to overweight the U.S., especially when you compare it to the emerging markets that aren't getting stressed by a strong dollar. A lot of these emerging markets, both governments and local borrowers borrow in dollars, and to have the dollar kind of scream like this to the upside it puts a lot of stress and strain on their ability to pay. The good news is that a lot of the stiffing that's going on in terms of bad debts is actually happening to the Chinese government, which lent out apparently about $1 trillion in its Belt and Road Initiative, and now it's coming back to haunt them because a lot of these local projects aren't paying for themselves, and the Chinese are winding up having to take ownership, which doesn't sound like a bad thing, except the political repercussions are going to be awfully nasty. So I don't think that, I don't think we're going to have a credit crunch, something breaking in the US. You never know, and it could happen, but the banks are in really good shape here. I know your banks are in good shape. Correct me if I'm wrong. But I think they are, but I think European banks are probably more exposed to emerging market debt. I think the UK situation with this pension derivatives issue, clearly that's something that's breaking. Italy has needed a lot of love from the ECB to keep them from blowing up. So there's a lot of moving parts in the global economy and financial markets, and I think on a relative basis, the U.S. dollar is probably going to continue to benefit from that, and that means net capital inflows into the U.S.
So, so that's helpful. So, in terms of where do the markets bottom and what's the catalyst for them to go up?
Yeah.
I guess it's any combination of better inflation readings like you saw today, which if the market sees as indicative of forward trends, a clear indication expressed by the Fed that it's near an end. Or I know you brought up the idea of a Powell pivot, possibly like pausing QT, for example, if it created some financial instability. I'm going to ask you in a minute about Volcker 2.0 and Bernanke 2.0. But for now, just in terms of the catalyst for the market to bottom and start to recover, are those the three?
Yeah. Well, for all we know, this is it. There's no way to really tell. In the good old days, there was the old motto, "Don't fight the Fed." And when the Fed was fighting inflation, they'd raise interest rates, and you didn't want to fight them, and you didn't want to own stock. And then when the recession hit, and they started to conclude that they had done enough damage to the economy and inflation is coming down, they'd start to ease. And really, almost the day they started easing, the market would rally. So don't fight the Fed when it's fighting inflation, and don't fight the Fed when it's easing. Don't overstay the bearishness. In the current situation, one of the reasons the market's done poorly this year is because the Fed put is kaput. Remember the Fed put? Since really the early '80s, we hadn't gotten used to the Fed coming in, and just when the markets were really taken a dive, they come in and bail it out. But that doesn't mean that there can't be a lot of pain. We had 2008, 2007, 2008, 2009, a terrible bear market, and the Fed was lowering interest rates, but it wasn't until they actually did quantitative easing that the markets really rallied big time. This time around, they've got the biggest inflation problem they've had since the 1970s. So even if we have a tantrum here, we've had a tantrum here, the Fed can't help us. They've got to really focus on bringing inflation down. And as long as they're doing that, don't fight the Fed, the market could continue to go down, I suppose. But then again, the Fed has been very aggressive in tightening. We've had, you got to get some Robitussin. Then again, the Fed's been tightening aggressively. 300 basis point increase in the Fed funds rate since March is huge. And on top of that, everybody now expects, especially after today's CPI news, that they're going to do 75 basis points again. You and I might look at the market as kind of people who've been in the markets for a while and conclude the market's telling us something. The market's telling us that when you really look at these inflation numbers, they are kind of rolling, and this will be behind us at some point, and it's not exactly going to be the end of history. So we can look at it that way. But I got to imagine the Fed officials looked at today's number and said, all the more reason we have to go ahead with 75 basis points in early November. So they're going to do that. And I think maybe what really finally gets the market to be just an unambiguous bull market is the perception that they're either done or almost done. Doesn't mean that they're going to be lowering interest rates, but I think if they go by another 75 basis points, and I think the market will figure out that we're getting pretty close to where they have said they want to be. They want to be closer to 4.5% to 5% on the Fed funds rate. So 75 is going to get us there in no time. And I think maybe there's a perception that the economy can withstand that, and that maybe we are going back to something at more normal times when we actually lived with inflation and interest rates kind of around these levels, and life went on and the market went up and earnings went up and all was well, and we had all sorts of other things to worry about.
So what sectors do you favor at the moment?
Well, I've been arguing that technology and financials and energy are good places to be, and of those three, energies clearly stood out as the right place to be, and the other two not so much, particularly technology. But when people get bullish again, that's kind of they run back into technology, they run back into financials. Financials in the United States are in very good shape. Their capital position is stellar. They actually are seeing loan demand increasing. They're not making mortgages, they're not making auto loans, but they're making C&I loans. They have lots of. They've already taken lots of charge-offs for write-downs. I don't know that they're going to have to really increase them. I mean, I'll be watching to see what Jamie Dimon does with Morgan's. I mean, if he thinks a recession's coming, then presumably we should be able to see that in him taking a big increase in provisions for loan losses. But that's okay. That just means that they'll have more loan losses to say that they didn't work out to be losses, and suddenly they become sources of profits again. Technology, I think anything consumer related, consumers bought a lot of technology, a lot of PCs and routers and so on during the pandemic. And now, everybody's kind of got at least one screen, if not three screens. I'm sitting here with three screens in front of me. I don't really need any new hardware. I think most people have what they want. And so anything PC related is in a recession. But anything related to servers in the cloud and technologies for productivity enhancements, I think that's remains quite strong.
And so I don't think this is outdated after today, but it's worth talking about, which is you had introduced sort of this concept, if you will, of the Fed after its pivot in August has morphed into Volcker 2.0.
Yeah.
And so basically Powell putting himself on this path.
Yeah.
And so do you want to elaborate on that? I guess
Yeah.
more or less the fear of pulling back prematurely or
Yeah.
stop at nothing.
Yeah, I feel a little uncomfortable doing that because I wrote a book called Fed Watching for Fun and Profit, and I actually criticized my fellow Fed watchers for being too critical of the Fed and accused some of them of actually being critical because they aspired to be heads of the Fed or get a position at the Fed. They all were monetary policy experts, and it's always been my opinion as somebody who provides advice to investors that my job and investors' jobs isn't to tell the Fed what to do, but to anticipate, get into their heads. What are they doing? How are they looking at things? What are they going to be doing? So, for me to criticize what the Fed's doing is not as important as for me to get it right what they are going to do, where they are going. But one of the themes of my book was that what Fed chairs say is extremely important. And you want to read all their speeches very, very closely, very carefully to get a handle on what they're thinking, because they influence everybody else on the committee. So I really spent a lot of time getting to know, if you will, Bernanke and Yellen and Powell. I think Powell's done a pretty bad job of late in communicating. As a matter of fact, I like to call the committee that he heads the Federal Open Mouth Committee, as opposed to the Federal open market committee because they talk too much. We only need to get to have him talk and tell us what the deal is. And if he gives us a 10-minute speech once in a while, that should do the trick. I think he gets himself into trouble by now doing what he's been doing, which is giving a press conference after every single FOMC meeting. Before he made that decision, it was 4 times a year. And when Volcker was around, he never gave press conferences, not scheduled ones. Once in a blue moon, he'd do a kind of a special one, like the Saturday night special that he announced that he was going to let interest rates rise to whatever levels were necessary. But I think Volcker at Jackson Hole and the speech he gave in Jackson Hole, Wyoming, back in August 26, just said, basically, forget everything I said in July. I'm now going to do Volcker 2.0. I'm going to let interest rates, I'm going to raise interest rates until I see clear signs that inflation's coming down. Things have changed a lot since then, but some things haven't. I mean, what we do know is that when the Fed goes into tightening mode, things can break in the financial system, and then before you know it, they're actually forced to lower interest rates. And I don't think they want to get themselves into a situation where they're lowering interest rates because they broke something in the financial system, or their policies led to something breaking in the financial system before inflation's actually come down. That would not be good for their credibility. So I liked what they were saying in July. It made sense to me. It made sense to me for them to be raising interest rates, in July and September and maybe December, and then pause. I think that was what they were communicating. That's what Powell was communicating, is that at some point they're going to pause. He actually said in July that there's a lot of tightening, there's a lot of tight monetary conditions in the pipeline, is the way he put it. And you raise interest rates by 300 basis points just since March, and you see mortgage rates go from 3 to 7%. It's at some point becomes, you don't have to lower interest rates, but just give it a rest, pause, see how it plays out. And then, I think they made a mistake back in the summer of 2020 when they became very liberal. Some people use the word woke, but they basically said that our policy, our dual mandate now, we're going to give more weight to bringing the unemployment rate down, and worry less about inflation. They should have kept it even, Steven. A central bank, almost all central bankers, other than the Fed, have only one mandate, and that's to bring inflation down. It should also be financial stability. I think that should be their number one raison d'etre. But and then inflation, and then unemployment. But the Fed made it unemployment, and to the detriment of what happened with inflation.
So that's a good segue, actually, because I know you have written many times that your concern is that because the Fed would appear to be so single-minded about defeating inflation, that they might end up creating some sort of financial instability. And I think you had described it as Bernanke 2.0. Right. And I know you addressed most of that, but the one thing I wanted to ask is, I know you had said they don't want to reduce rates, but do they not also have another tool, which would be to pause quantitative tightening? Because they're basically buying or letting roll off 100 billion a month, give or take. Right. And just by doing that, do you think that might be an insurance policy against?
Yeah. I mean, if something breaks, they don't have to lower the Fed funds rate. They could announce that they're going to pause raising the Fed funds rate, but they could also give us a package where they also say we're going to pause on QT instead of letting mortgage-backed securities and treasuries mature and no longer own them. We're going to roll them over. QT just doesn't seem to be anything that they're focused on. They just every now and then they mention we're raising interest rates, and then they spend a lot of time talking about that. They never talk about the tightening impact that the strong dollar has as another source of monetary tightening. And when it comes to QT, they just mention, and that's what we're doing. And they don't really have any clue of what impact that's having in terms of the package that they're presenting of monetary policy. I think a QT is at least a 50 basis point hike in the Fed funds rate. And I think that this is conjecture. I mean, it's not zero. I'm not going to go and scare everybody and tell them it's 100. I think it's reasonable to say it's at least 50. I think it's reasonable to say that 17% increase in the DXY dollar index, that's at least 50. So we're already got 100 basis points of tightening in the market from those components of monetary tightening, and they don't seem to acknowledge that. Back in 2010, when they wanted to do QE2, they had no problems telling us that their econometric model said the Fed funds rate needed to be minus 75 basis points. Back then, central bankers weren't aware that they could actually give us negative rates. So instead, they did QE2 and said $600 billion in QE2 is equivalent to a minus 50 to minus 75 basis point Fed funds rate. So they actually were very aware that QE was stimulative, and now when it comes to QT, it's like, you don't hear nothing, you don't hear anything about it.
Yeah. So, but I guess central bankers can't do, as we all know, they can't do everything. Fiscal policy is a major variable, and it seems, and I know we talked about this the last time that we had one of these webcasts, which is fiscal policy. There's been sort of this global shift away from pro-market policies, fiscal discipline. There's, I would say there's a general decline in the competence of the political class.
Right.
But it would seem right now, and maybe, and I'd be curious to see if you agree or disagree, is that right now it seems like almost everywhere, with perhaps the exception of Australia, that fiscal policy is working at cross purposes with monetary policy.
Right.
There's still very big spending government, and the Inflation Reduction Act was somewhat misnamed. In Canada, there's still large spending, and in the UK, obviously there was some issues there, which I'll ask about in a moment. Are you worried about that this is creating additional uncertainty, and that might have the Fed sort of overcorrect because fiscal policy is not, like, the governments aren't really working to align themselves?
I think you're bringing up a very important point. Is most of the daily chatter in the financial markets tends to be about the Fed, and got this obsession with the Fed. The problem is it's kind of hard to keep track of what they're doing on the fiscal side, other than when they pass a bill and then we got an idea of how much they're going to spend, but they tell us how much they're going to spend over the next 10 years, and then it takes a while. So I think the markets perceive that monetary policy you can touch and feel and understand pretty rapidly. You can see what interest rates are doing. You can see what's going on in the capital markets in terms of the Fed's intervention. Whereas when it comes to fiscal spending, who really knows? I mean, we do have monthly data coming out of the Treasury on what they're spending in current dollars. So we have to adjust that some of their spending is inflation. It's good to be king during periods of inflation, as long as you don't let it run too wild, so you don't get a revolution and then they arrest you if you're lucky, behead you if you're not so lucky. But inflation is a pretty good deal for governments, and our government has gotten a lot of revenues from inflation. It's not so much a stealth tax. Everybody knows that we're paying more in taxes, and it's a burden. But I don't have an answer for that. I mean, other than I'm a fiscal conservative, and I don't like what I'm seeing, and I think a lot of money is being misspent and not spent properly. And only now are we starting to get all sorts of stories about just how much of the COVID money was pilfered, and they're just throwing so many billions and trillions of dollars around. It's not a healthy. I mean, you got on the screen here, we got Hamilton. I mean, it's probably rolling over in his grave for sure.
Do you think the midterms, which happen in about a month, could influence the markets if the Republicans take control of either or both the Senate or take over all of Congress, or one of the two branches?
Well, I think there was some expectation that the Republicans, were a shoo-in to take over both houses. Now, with some of the controversies we have, that's not necessarily the case. The Democrats are pushing the point about women's rights over their health and bodies, and the Republicans are pushing on crime, and so I think it's most of the races I'm seeing are like kind of evenly divided, where maybe somebody has a slight advantage over somebody else. It's not a shoo-in that the Republicans are going to get both houses. I
But
mean,
even, but even if they got one,
Yeah.
it could slow the pace of.
yeah, I
They
hope
could
they
control fiscal policy.
I hope
or
they
veto it.
do. I hope they do, not because, not so much because I'm favoring one or the other, but rather gridlock is bullish for the markets. It's a good thing when they can't just do willy-nilly whatever they like. So it's still possible, but I don't think the market is discounting a Republican sweep. I think we're all going to be looking to see what actually happens before coming to any conclusions. So I'm in the same position. I can't really predict how this thing will play out.
Yeah. So that's very helpful. So we have about 7 or 8 minutes to go.
Sure.
So I wanted to segue towards geopolitics, which unfortunately, have some unfortunate events. But I guess there's really kind of 2 things that stand out that are, one is sort of happening in real time. Well, both are happening in real time. But the first is, the potential for an energy crunch in Europe as they head into the winter, and whether that puts upward pressure on energy costs and therefore puts upward pressure on global inflation. Is that something that you're concerned about? And then the UK appears to have made changes that have, resettled the market.
Yeah. I think with regards to the energy story, can't avoid talking about having some opinion on climate change and how we've been managing the transition. I think reality bites, and some of the events of this year have made people realize that the transition from dirty energy or fossil fuel, whatever you want to call it, to clean energy or renewables is not so easy, and that renewables aren't necessarily ready for prime time, and this political movement to stop production of fossil fuels is now turning out to be creating some nightmare situations, like in Europe, where they were too naive about the transition, and so they shut down some nuclear. They didn't promote gas or any fossil fuel production in the local market, and became dependent on Russia. And we all know how that's played out and how that's playing out. So, now Europe is suddenly very dependent on whether it's going to be a really cold winter or not. That maybe they had enough time to kind of prepare, but again, much will depend on how much they have energy they're going to need. And then what? Okay, so winter will be over, and then what? Then there'll be summer, and the problem has to be solved. And I think it's going to be solved by the U.S. political stars changing in a way that is more consistent with the reality that we just can't basically ostracize and ban fossil fuel supplies. It would quite the opposite. Jamie Dimon himself said that the U.S. is actually the swing producer in the oil market. It's not Saudi Arabia, and yet we've got a president who's going all around the world and begging the Saudis, begging the Venezuelans to produce more when we could do it just as well. I never quite understood why it makes more sense for us to burn, Venezuelan oil or Saudi oil than our own oil. It's the same issue that the Europeans need to ask themselves: is why did you buy all this fossil fuels from Russia and think that was somehow a plus for the environment? So those kind of realities are hitting home, and that's one of the reasons I recommend overweighting energies, because I think we're getting a more realistic view of the importance of making a careful transition, and that transition means that we continue to need fossil fuels. But it could be a contributor, obviously, to inflation. But as we see, the high oil prices have certainly and the shortage of energy for Europe is contributing to a slowdown in global growth. China's got issues related to horribly managing the COVID pandemic, combined with horribly creating a property bubble that are slowing their economy down. So they could, and the IMF is talking about much slower economic growth. And so, OPEC may very well have to continue to cut back its production just to keep the price of oil from actually tanking. I think the price, I don't see the price of oil going up to 150 to 200. There was some talk about that. I don't see it going down to 60. I think, in this kind of range of 80 to 100 is probably going to be it, which again is good for fossil fuel companies. I would hope that they will actually increase their capital spending because they were discouraged from doing so, which for them was like, okay, if you don't want our oil, you don't want our gas, fine. Watch the price go up and we're going to charge you more and pay our stockholders more in dividends and buy back shares. But now if the politics becomes a little bit more reasonable, more realistic, I would, especially liquid natural gas. I mean, fossil fuels will become a national security issue. Well, I mean, we're running down our strategic petroleum reserve just because for political reasons, Biden doesn't want the price of gasoline to influence the midterm elections. I mean, that's bluntly what's going on there. But it could be a source of inflation, but I don't think so because energy has this tendency that when the price gets too high, there's a lot of demand destruction pretty quickly.
So last question, asset allocation. Do you generally favor equities over fixed income, or is there something that we should know about?
I don't know what kind of I don't know much about your capital markets with regards to municipal securities. We have in the U.S. we have the municipal bonds, and I live in New York, and I like Four Seasons, so I like the weather here, and it's a good lifestyle here. But on the other hand, there's crime and it's expensive, and so on and so forth. But I'm staying here in New York, and so triple tax exempt municipal securities are yielding like 3.5% to 4%. I mean, it's a pretty good deal. I mean, the stock market on a trend basis gives you basically, a long-term trend basis, it basically gives you that kind of return. I think fixed income securities are looking certainly more interesting, especially if we have a growth recession, and if that's kind of parallels what you folks in Canada experience. That's not one where credit quality spreads blow out, and you're losing lots of money because of credit quality. So I think high yield and investment grade bonds and bank bonds are actually pretty attractive here. And stocks have gotten very cheap. If we're not going to have a hard landing, I think it's a stock picker's market. I think we've moved away from the S&P 500 passive investments where people just put money in a S&P 500 fund. And the advantage that those kind of ETFs have over active managers is, as you know, an ETF can have 25% of its portfolio in 8 names because that's the size of the market cap of the S&P 500, whereas a prudent manager wouldn't go to that extreme. So I think we're getting back to a stock picking environment, but as all things, it's not one or the other. I mean, there's certainly ETFs that are attractive and efficient in terms of the fees and all that.
So, okay, I think we've used up our hour. So I just wanted to say on behalf of Hamilton ETFs, our firm, and my partners, and those who attended, there was hundreds and hundreds of people. Thank you very much for your time and attention, and have a great day.
You too. All the best, everybody.